What's a classic Jamie Murray stock?
We like to have a good starting valuation. That does mean we won't buy a 25 or 30p multiple. We like to see a business model that 3 to 4 years, you're going to have pretty good cash on cash returns in the business.
We go hunting for cash flowing bargains with Jamie Murray of the Murray Wealth Group.
We own Meta. We trust Mark to figure out what to do with the CapEx.
It's up 56%.
This is a name that I owned until 3 days ago.
Breaking news.
Yeah.
Why Uber hasn't participated, because it has a lot of AI bona fides.
One word answer for why Uber hasn't participated is Waymo.
Air Canada.
We like the new CEO. He's got a good track record.
How's his French? Did you test it? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. On this episode, we discuss Go Residential, UnitedHealth, and Meta, which are all stocks that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Canwar. On this episode, we've got Jamie Murray of the Murray Wealth Group. I always love talking stocks with him. That's pretty much all we do this episode. He was our 12th guest, and now he's coming back for our 146th episode. So we're very grateful that he came early when the show was in its infancy, and we are especially grateful that he returned. And you especially want to stay tuned for those pro picks. These are not household names. You will not hear them on BNN or CNBC. These are off the wall names and I think pretty interesting. So stay tuned for that. And we go through Jillian, 7, 8, 9, 10, lots. She's saying lots of stocks. So get your pencils out, a lot of stocks that we can do homework on. And if you want these stocks, these pro picks right to your inbox, go to our website. inthemoneypod.com, smash that subscribe button and you will never miss. Let's get into it. Jamie Murray, thank you so much for rejoining us on the podcast.
Thanks for having me back.
You were episode 12 and now you're episode 146.
Yeah, that's crazy. I mean, congrats to you on all your success and glad just to be back talking to the listeners.
Thank you. Well, I feel like now it's episode 146. It's easy to say yes to, but episode 12, I feel like you took a bet. So thank you for making that bet kind of early on. And coming to talk to us, here we are, we're in the deep of summer, July, earnings season is just starting. And I don't know, maybe it's just me. I'm tired. I feel like the market's also a little tired. It's sort of, we're getting these pretty amazing earnings stories, blockbusters from, especially the financial sector and a little bit from the AI sector and just a real yawn by the markets. What's going on?
Yeah, certainly there's multiple factors at play, but the expectations going into the quarter for some of these names are very, very high. The buy side is generally much further ahead than the sell side. So when you see those big beats versus consensus, it looks impressive, but a lot of the buy side investors are already sketching out their models and maybe have numbers closer to what actually get reported. We're also seeing, in the case of some financial companies, cost increases. And they're investing in AI. And like we saw with the hyperscalers, those investments could and probably will pay off over the long term. But the street and investors don't always love it today when you're spending gobs of money on compute, engineers, talent. So it's really going to be a show me story to see those returns follow through.
I mean, we're seeing that in memory. Obviously, that's been, that's no secret. The price of memory chips has skyrocketed, except now it's working its way through the supply chain and it's forcing price increases. It's driving up the cost of doing things. A lot of the CapEx increases wasn't because, oh, we're going to do more. It's like, oh, it's actually the same thing that we want to do. Now it's going to cost more.
Yeah, exactly. And so the hyperscalers kind of got memoried in that way where we're increasing, but it's all just going into Micron's pocket. And now that's happening to Micron where it's flowing into ASML or the semi-cap companies. And so ultimately this all just flows back into capacity and resources, and it's a big circle. And I mean, that's why we do prefer the hyperscalers for our sort of primary bet on the AI. They're fully integrated. They can increase their capacity as much as they can, and if they don't end up, having business or the ability to sell all that, they can use that internally. So there's lots of ways to win with these companies, but certainly while we're in this huge shortage of, it seems like everything, you're going to see a lot of volatility in the sector.
The hyperscalers are interesting because in a lot of ways, as a group, they've lagged. And so I guess my question is, and we're going to talk about some specifics, don't worry, but my question is, like, which way are you leaning in this trade? Like, how are you placing your bets in the market right now? Are you sticking with the large players and that's still the way to go? Do you have a temptation to move down cap to something a little torquier? What does it look like in your portfolios?
Yeah, we definitely like to stay with the big guys. And even buying up some of the underperformers within that group. And so, I mean, in 2026, that would be Microsoft. Mm-hmm. We're not big believers in this whole software is dead. We think enterprise software is really going to be that orchestration, the governance, and really the adult in the room when it comes to using AI for an enterprise. And Microsoft is really the leader, globally in this. We've also been nibbling at ServiceNow, a new stock for our portfolio that we think is going to be a big beneficiary from AI, particularly as these models get cheaper and cheaper. And we've seen that just in the past couple of weeks. We saw new models from Meta and XAI, now part of SpaceX. They're not quite frontier, but they're good enough and they're cheap enough that they're going to get business. And as NVIDIA comes out with next generation chips, new models come out, we're going to see the cost of intelligence continue to fall. And I think that's going to be bullish for these software-led companies.
Yeah, I want to stick with that because I'm actually not buying them, which is unusual for me because I love a broken story. It's my favorite thing. But the thing that keeps me restrained is I truly don't know how it's going to play out, right? Like we don't know what does Claude have up its sleeve in the fall that can render these businesses moot. Like, why doesn't that stop you from buying ServiceNow? Because you could just buy anything else, right? Like you don't really have to be in software right now.
You're right. We don't have to be in software, and we weren't really in software in 2021, 2022 when the valuations were double or triple. And we always lead with what's the valuation, what's our target looking out 3 or 4 years based on a normalized valuation. And so that's how we're getting to some attractive returns on these software companies. Now, you're right. The existential piece is the big question. But we view software as much more than just the code. It's the maintenance of the code. It's the day-to-day fixing code that breaks. It's the day-to-day adding new features. Now, AI can do that and can automate a lot of that. But we ultimately think that the incumbent software companies with the data, with the relationships, are just going to be able to use AI internally to increase the speed of their own development.
Sticking with the debate around big versus small, you're obviously sticking with the large hyperscalers, and I've just been looking at the kind of quiet outperformance of the Russell 2000. Everybody thinks, oh, the NASDAQ, how exciting, but the Russell has been quietly outperforming, and you think, oh, small caps, little mom and pop shops that are exposed to the US economy, the best performing stocks on the Russell 2000, the small cap index, they're really AI stocks, right? Like Air Test Systems, for example, which is up 300%. it's almost like AI is bleeding into these other areas of the market. You wouldn't think small caps is an AI trade.
No, exactly. And I mean, I think that is just the amount of stress we're seeing on the manufacturing system is that it is starting to bleed into other parts of the economy, which is, I mean, it's great for the US economy. I mean, the AI build out is driving a lot of their GDP growth that other companies or other countries, can't compete with right now. And we're seeing that suck up capacity for all types of tradespeople, manufacturing sites. And yeah, who owns those types of businesses? I mean, those are the companies in the Russell 2000.
Are you surprised that the market isn't more roiled by the flare up once again between the US and Iran and higher energy prices?
So we're not too surprised. I think there's two reasons. First, in the the first Iran war back in March.
All the way back in
March.
All
the way back in March. We did see energy demand adjust pretty quickly to the higher oil prices. And just given the world in a post-COVID digital virtual world, we're still able to function as a society, even if we're not driving our cars as much or using as much oil to generate, that economic activity. So we are seeing that demand flexibility that wasn't possible 20, 30 years ago. And second, I mean, I think given the concessions and how that first deal was shaping up, it seemed pretty favorable for Iran. And it seemed like the US was coming out in a worse position than they started. It's, as you said, flared up again, but I think most investors are looking through this and saying, we think that the US is going to do what they need to do for damage control to keep oil prices, keep gas prices, especially with the midterms coming up. We don't want the whole economy going off its rocker. And so, Mr. Trump likes to negotiate hard. And we just think this is another negotiation tactic.
Because the risk for the broad market, even if you don't care what happens to the energy sector, is that it is inflationary. It causes rates to move higher. And, ultimately you've got tech stocks borrowing like they've never borrowed before. This is a rate sensitive, the markets are always rate sensitive, but if you have an unfavorable rate shock, that's probably the biggest risk to the market right now. I
mean, that's certainly a risk that's out there. And I mean, I'd say more the US budget deficit is sort of the biggest rate shock potential that we can see. But ultimately, I think there's a lot of deflationary forces. Like we are seeing AI start to actually permeate into businesses. We're seeing businesses become more efficient. We're seeing businesses find ways, not just through headcount reduction, but internal efficiencies, optimizations that weren't possible before. We also are seeing capacity on manufacturing, energy delivery start to accelerate again. So we went into this electricity, not quite a shortage, but a bit of a shock, given how much these AI data centers are needing. And now we have a pretty clear pathway for how we're going to meet that and continue to grow energy consumption and supply over the next 5 years. And so the world is adjusting. And I mean, I think ultimately we are going to see inflation trend back to that, maybe not quite 2% or below, but 2 to 3% range by 2027, 2028. And that should keep the long end of the curve in check, we think.
And maybe speaking to the sustainability of rising oil prices, I think it's interesting that this time that oil prices are moving back up, energy stocks are not really following.
Yeah, and I mean, I think, again, that's the market may be looking through this negotiation tactic again. And oil, since 2008, we've seen continued efficiency in the production and delivery. I mean, oil sands companies today in Canada are way more efficient on both the CapEx side and the production side. So their marginal costs are down. We're seeing actually AI is accelerating oil discoveries. Like BP found a huge discovery, the Boomerang offshore Brazil. And they said that we worked with NVIDIA to look at our mapping and found some pools that we wouldn't have found otherwise. And now they have a huge discovery there. And so we think we're going to see an acceleration. And that's, again, plays back into that deflation story. Maybe not deflation, but lower inflation as AI is going to make businesses more efficient.
We've got a ton of stocks in the mailbag, so I don't want to keep us from that. Just at a high level, what's a classic Jamie Murray stock? something, what boxes do you need to check for it to get into the portfolio? What are you looking for?
Yeah, so we like to have a good starting valuation. We're very valuation sensitive. That does mean we won't buy a 25 or 30p multiple, but we're probably not chasing the stuff that's on an EV revenue multiple. We like to see cash flow, and we like to see a business model that 3 to 4 years, you're going to have pretty good cash on cash returns in the business, call it 6, 7, 8% free cash flow yields. So a pathway to that. And so it's a nice universe. There's lots of companies. And as much as some companies have moved out of that trading range, we've seen lots of attractive companies move into that trading range.
All right. Well, let's see if we can find them and dip into the mailbag.
Sounds good.
The mailbag is brought to you by Hamilton ETFs. The traditional 60-40 portfolio, 60% stocks and 40% bonds, has been a cornerstone of investing for decades. But it relies on one key idea, that stocks and bonds offset each other. And in today's market, that hasn't always held up. And it isn't always about performance. It's about managing volatility. That's where the Hamilton Enhanced Mixed Asset Allocation ETF, ticker MIX, comes in. MIX. Think of it as an evolution of 60-40. It combines 60% equities, 20% bonds, and 20% gold. Gold acts as a third layer of diversification, which has historically been a safe haven during market stress, an inflation hedge, and less correlated to bonds and stocks. So instead of relying on 2 asset classes, you now have 3. When you backtest the mixed asset index back to 2004, you get similar returns to the S&P 500. And when you add leverage, modest leverage, 25%, the index has historically outperformed. And importantly, the index's volatility has been lower with this 60-20-20 approach, even after modest leverage. And the index's drawdowns during market sell-offs has been less. An example is during the financial crisis. The S&P 500 fell 55% peak to trough. The mixed asset index only fell 27%. And even with leverage, it only fell 33%. So you get historically shallower declines, smoother returns, and typically faster recoveries. And that can matter because investing is not just about returns. It's about whether you can stay invested long enough to achieve them. Mix is designed to seek long-term growth with a more balanced and more manageable investing experience. A modern mix of stocks, bonds, and gold built for today's market. For more information, visit HamiltonETFs.com or visit the link in the show notes. Our first question is on Uber, and it has not participated in the tech rally at all. In fact, it's down 10% in 2026. Talked about valuation. It's around that 25 times earnings. Let's spend a beat on just why Uber hasn't participated, because it has a lot of AI bona fides.
Yeah, so the one-word answer for why Uber hasn't participated is Waymo.
Yeah.
So Waymo, Google's autonomous vehicle platform, is growing very quickly across the United States from a very small base. But in San Francisco, the current figures we've seen is that Waymo might have 25% market share in a market that it entered. It was one of its first markets, about maybe 4 or 5 years ago. And so that's the bear case for Uber, is that, well, we're not going to need Uber because we'll just have Waymo, and Waymo's going to take us wherever we need to go. Now, acknowledging that Waymo's a great company, we own Alphabet as well in our portfolio, so we're happy to see that. But there's 2 kind of pushbacks we have to that. So first off, you always want to have that flexible driver supply. You don't want to have a whole entire fleet of autonomous vehicles in the city for sitting idle at 3, 4 in the morning. So you have that flexible driver supply for that night where there's a game or a concert and you need a ton of Ubers in a downtown area. And it's really only going to be a 3-4 hour window. You need to have those cars. There's still going to be a peak supply that Uber is going to fill. And it's really just that base load is probably going to move to autonomous vehicles over the next 5 to 10 years. Now, the second reason why is Uber is not standing still. They're building out their autonomous vehicle platform very rapidly. We think they're going to have just as many autonomous vehicles on the road as Waymo does by 2029, 2030. Uber is a global company. They just bought Delivery Hero, which further builds on that in Korea and the Middle East. And so we think, is going to be rolling out autonomous vehicles worldwide. They have an X factor. That's a company called NVIDIA. So NVIDIA is really the brains behind a lot of these autonomous vehicle startups. Uber is the demand generation platform. And so as much as Waymo and even Tesla are trying to build this out all on their own, they're competing against Uber, and Uber's got NVIDIA, who's made it a very big bet to get into this market and also doesn't want to lose out to these companies.
And I think your point on delivery too, right? Like that's a diversified business versus, just relying on the ride sharing, and the delivery business is growing quite quickly.
Yeah, and delivery is a whole other bull case on its own. So that's a great point. Thanks for bringing that up, because we tend to get lost in the ride share, which now after this Delivery Hero acquisition, the delivery business on a gross market value is probably bigger than ride sharing. And we're still in early innings for what delivery could be. I mean, there's talks, in 10, 15 years, we're going to have not just autonomous vehicles and trucks delivering goods, autonomous trucking around the country, which Uber is going to participate in, as well. Even do we get into drone delivery when drones become cheap enough and ubiquitous enough to deliver packages and parcels? It's probably not going to be the everyday items. You're not going to get a box of coffee dropped off at your house from Amazon via drone, but time-sensitive items, high-value items, we think drones a long-term play as well.
And to your point about cash flow, like there's something of a, we asked a company like Uber in 2022 to grow up. And not a lot of tech companies were able to grow up, right? And Canada's littered with companies that weren't able to grow up. And Uber went from generating, call it $400 million in cash flow in 2022 to $10 billion in 2026. Like they really grew up. They heard that message and their cash flow just exploded.
Yeah, so they were the leading company, I think, behind that charge. And Dara, the CEO at Uber, put his money where his mouth is, bought some stock and said, we're going to start delivering cash to our shareholders. And they've delivered, over-delivered on that promise for 5 years. And sure, this Waymo and autonomous vehicle build-out might be a bit of a choppy period for the next 2 or 3 years. But ultimately, I mean, this is a business that's grown tremendously just over the last 12, 13 years since its founding. And we still think it's early days in the Uber life cycle. And to be able to buy it, I think it's actually sub maybe 20 times forward earnings on the next 12-month basis, with, like you said, lots of cash flow buybacks, and this autonomous vehicle that is also going to expand the TAM over the long term. Uber is one that we've been buying up.
The total addressable market. I might let you convince me to buy Uber. I don't own it right now, but I really wanted to understand the story, so I appreciate that. The second question we have is on Meta. And I mean, what do investors want from Meta right now? The stock, you mentioned choppy, like the stock has been very choppy. It's basically flat in 2026. It's cheaper than it's been in years. It's one of the only companies that seems to actually be benefiting from AI. It is leading to people spending even more time. It's making their advertising delivery even more efficient. What's the problem? Why are investors so ho-hum on Meta?
Yeah, the problem with Meta is, again, that CapEx spending and what are we going to get for this money that you're spending? The first part, on their core business, they've built some great advertising tools that are all AI native. Their Advantage Plus creative platform really allows a small business to say, make me an ad, tell me who I should target this ad to. And if the ad's not working, change the ad to increase conversion, increase the audience, increase whatever the KPI that you're trying to track towards. And that's been a huge success. That's what's driving. We saw both price and impressions for Meta ads accelerate in the first quarter. They grew revenue 33% in Q1. That's by far the fastest out of the hyperscalers. They are going to probably surpass Alphabet, Google in pure advertising revenue by mid-2027 on just a total dollar value. So they're going to become the largest advertising company in the world. So lots to like on the core business. It's really just been, we're making tons of money on ads. Let's just dump it into CapEx and see what we can stir around and come up with.
And I guess, the history is not on their side with their recent.
Exactly.
They changed the name. The
metaverse,
metaverse was a boondoggle, several $billion waste of time, which was okay because the core business still did well.
And I mean, that was during a time where the core business was challenged from some changes at Apple. That was TikTok was all the rage at that time. So certainly a little bit more sensitivity when they're going through that. And the Horizon Worlds platform, sometimes they'd spend billions of dollars on it. And there's like hundreds or dozens of people inside this world they built.
Still, they're trying to figure out how to get out.
Yeah, exactly. So it's got to turn the power off on the headset. But that's why at least this CapEx is going into something real, like these AI data centers. There's a huge shortage of AI compute. We think this idea to have Meta start maybe selling some of their capacity makes sense. It's not about selling. They're still compute constrained as well, but it's about timing when the compute comes on. Do we have older generation chips that we can move workloads to? Or do we have older generation chips we don't need anymore that we can rent out? So it's going to be a good business, I think, for them.
The strategy is also so now they're going to be making their own chips. And initially they were just going to be doing that for themselves. And then they come out and say, oh no, we're going to sell it to other people as well. And I thought, is that's confusing. And does it mean you have to sell it to other people because you actually don't have enough to use it, like in your own systems? You're not getting the sort of apps or development that you thought you would out of it. So now you've got excess supply. Like, how do you think about that? Or is that one of the other things that puts it in the too messy category?
No, I think it is a bit convoluted, their whole strategy. And I think it's mostly comes down to timing mismatches on when they need the capacity. Obviously, they use capacity for their core business. There's even during a day, when everyone's at home from 8 to 10 p.m. on Instagram, their internal algorithms are working overtime. 3 a.m, maybe there's not a whole lot of activity on their servers. So it's about matching when they're using it to when they have excess demand.
Do you like Meta? Would you buy it?
Yeah, we own Meta.
Okay.
And we like it. I mean, again, the PE ratio is down below 20 for a company that's going to grow. At least the top line and the cash flow is going to grow 20-25% for the next 3 or 4 years. And we trust Mark to figure out what to do with the CapEx.
You do. Okay, that's big because maybe some people don't. I'm Mark Zuckerberg. Okay, the third question, it's a little painful for me. You and I have history with this Aritzia.
Oh, yeah.
And it's the thing was when it was really down and out, Jamie said, you should buy it. And Amber did not buy it. And then it proceeded to go, I'll be generous. I'll go from the lows of 2025. It's like up 350% since then. And it was, they were in a funk. They had the wrong fashion. They had too much inventory and you're like, they're going to get it together. And they did. The question though is if you're a loser like me and you sat the rally out, can you get back in?
It's not the screaming buy that it was.
Yeah.
We still own Aritzia. We have about a 3% weighting in our global fund in the name. But that's down from 4 to 5% even just a few months ago. They just put out another quarter this month. It was a great quarter. Their comps, their comparable sales were 35%.
They're explosive. But does it not remind you of Lululemon sort of back in the day?
Well, it does in some ways. Lululemon grew at a huge rate for a decade. And I mean, we think Aritzia is going to grow very strongly for the next 10 years. The problem is the valuation, which we were talking about earlier, is moved up. It's closer to 30 times PE ratio. There's a couple of asymmetric helpers that they had last year. They launched their mobile app. They increased their digital marketing. And so those two factors, I mean, now they have the app, they have the marketing, but those aren't going to be kind of coming out of left field to provide an additional tailwind. And so we see this as a company that's going to have to show that how are you going to grow? You grew 70% over the last 2 years. Your valuation multiple doubled in that time. Now, what's the next couple of years look like? So there could be a digestion period with Aritzia.
You're still holding?
We still hold some. We did sell some
okay.
like in the last couple of months, but Let's not forget, this is a stock that did hit sub $40 just 15 months ago in that tariff sell down. So it can be a volatile name. There's going to be points we think to get into it. Like I said, if you're thinking I've owned this for 3, 4, 10 years, I have a huge capital gain, I still like it. I don't think you need to dump it and run. I think it's got a pathway to hitting $200 and beyond in the next 3 to 4 years. But I wouldn't be shocked if in a year we're here and it's around the same price.
All right, it's 143 now. Another stock you and I go back and forth on is Air Canada. And sometimes you're in, sometimes you're out of that stock. And I feel like Air Canada, that's what it's for. It's a nice trading stock. It did surprisingly well almost a few weeks after the Iran war began in March, as investors really quickly tried to price out what was going on with oil prices. Now it's pulled back a little bit. What do you do with Air Canada here? Because it took a long time to work.
It did. And I think it was just a couple of weeks ago, it did hit a 52-week high, and kind of like a 5 or 10-year high was getting up into that range around $25. But I think this is a case you want to hold it and wait for it to break out higher. So
is it going to? $26 per share has been a big lid on this stock for 5 years.
I think it is. And I'll tell you why.
Yes.
So here's why. So, I met with the company a couple of months ago, post the Iran war and the oil price spike.
Pre-CEO change?
Pre-CEO change.
Okay.
We like the new CEO. He's
got
a good track record.
Okay. How's his French? Did you test it?
Yeah, I haven't tested it. I'm not the right person to test that. I quit French immersion in grade 6. But
okay.
No, so why we like it is they have a lot of demand that is not as effective, price sensitive to oil prices. So there's a big cargo business. The premium business is they over-index the premium and international. A lot of that is price insensitive. We're already paying $5,000-$6,000 for a lay flat first class seat. What's another $1,000? It's our annual European trip. We're going to do it no matter what. And so we think Air Canada's demand is going to hold up well. If we do see oil prices pull back, they've priced a ton of their booking curve at higher prices. So if we see oil prices kind of stay down, they're going to have a huge profit boom. If oil prices move up, that's not going to be great, but they're going to be less affected than other airlines globally. The second reason why we like it, they're just at the point where they're actually getting some of these new airplanes. So they have the A321neo. These are single narrow body planes that can fly from like Toronto to Montreal deep into Europe. So they can fly year round. They're better capacity for flying like Toronto to Nice in October when you're not maybe at the peak summer levels, but you can still get a full flight of people. And their hub and spoke strategy, a lot of their passengers are American travelers trying to get to Europe, and it's just as fast to fly through Toronto, Montreal as it is New York, Atlanta. The new premium lounge, if that's who you're flying, it's a really nice experience. So that's the second point. And then the third point is they are running this big CapEx plan to bring in these new airplanes. This is going to moderate in 2028, 2029. So you're going to see that free cash flow really inflect higher. It's about a $7 billion market cap today. They could be doing $1 to $1.5 billion of free cash flow after CapEx in those years. So that's like a 16% free cash flow yield. So they're going to buy back a lot of stock. And that's their long-term plan kind of contemplates hanging out at that level for the long term.
And I recently read a note from National Bank, Cameron Dorkson, about the Aeroplan business. People don't think about Air Canada and how big it is, but they basically, the note says they've doubled from 5 million members in the year in 2019, and it's, call it 10 million today, and that it is a meaningful generator of profitability. Do you think about the airplane business when you're owning Air Canada?
So it's certainly, it's buried in their financials, and we don't necessarily break it out when we're just looking at a consolidated, what's the cash coming out of this whole entity? Because the Aeroplan, it does feed into the premium business and into that whole value chain. But certainly, like Aeroplan used to be a standalone company. Air Canada spun out Aeroplan in I think the 2000s, and then they kind of spun it out, torpedoed it, and then bought it back on the cheap. And so I don't know if they can do that playbook again. But I mean, it was a smart business decision at the time. And I mean, now that they've got that in there as a real loyalty hook for that premium customer. And it is a meaningful cash generator inside Air Canada.
Smaller cap Exchange Income Corp has done incredible. It's up 56%. For those who don't know, what is the Exchange Income story? And I believe this is a name that you own.
So this is a name that I owned until 3 days ago.
Oh, breaking news.
Yeah. And,
okay, you took your chips.
We can talk about why we sold it.
Yes.
But what is Exchange? So it's a collection of industrial businesses. We first bought it in 2017. There was a short report. If you remember the chicken farmer.
Mark Cahodes.
Yeah,
I do. It was after Home Capital.
Yeah.
He started targeting Exchange.
I was actually living in Winnipeg at the time where Exchange is headquartered.
Yeah.
Thankfully, I knew some lawyers who worked at the law firm that they deal with. And they said, no, like whatever this guy's saying, like it's a legit company. You can trust what they're doing. And so we took a good look at it. And it's a really interesting business model they put together. And so they have aviation assets and then manufacturing industrial. The aviation is really what attracted us to the name. So they were buying up niche aviation businesses in Northern Canada, starting with regional airlines that fly into like remote northern communities. Then they started buying the like air ambulance and air transport for somebody on a northern reserve, maybe needs to get to a hospital in Winnipeg or Saskatoon. That's all a contracted business with the province. So that's a really good cash flowing business. And then it just, over the time, they just ended up owning all the pretty much aviation assets in the north. They just bought a company called Canada North, I believe, which is a Nunavut-based airline. And so now they're really the dominant northern aviation company out there. And where's all of Canada's investment going into? The north. And so they're seeing, increased payloads going into Nunavut. They got really good pricing. They're able to integrate these acquisitions. They do all their own maintenance on the planes.
So it became like a Canadian defense stock.
Yeah,
all this,
exactly. They bought pilot training schools to address the pilot shortage. They have air simulators, their own simulator. So they really built this great aviation business. And it's a leading aerospace and defense. And they also do intelligence and surveillance work. So off the coast of Greenland, which is pretty topical. It's their aircraft.
You've got to keep your eye on Greenland.
It's flying out there. So
why did you sell?
So, I mean, like you said, it's had a great run. The main reason we sold in our dividend fund was we have a hard 3% dividend rule. Once your dividend yield goes below that to 2% and below, we pretty much have to sell you out of that fund. And so this is where we held Exchange. And that's the primary reason why we started to exit the name. The other reason, I think, like you said, it's up 53% this year. It's had a huge run in the last 3 or 4 years. And if you've been in since
2017, it's actually up like 600%.
Yeah, we've done well over the long term. And even just in the last June, it was $50 and now we're at 135. There's a big Australian contract that they were bidding on, which would have been great if they won. Mm-hmm. And they missed out on that, which, that's going to happen. But even from the point where that was supposed to be like this next big catalyst, the stock's up 30%. So I just think it's maybe going to take a little breather, some consolidation, and there's some other interesting names we wanted to look at. But again, I don't think it's going to go, I'm not worried about it going down. I think this is a name in 2 years, I'll look back at it and it'll probably be 20, 30% higher. And I'll be like, oh yeah, okay. Makes sense. But better opportunities.
You got what you wanted out of it. Okay, we got 2 more questions in the mailbag before we get to your pro picks. One is on a REIT. It's Go Residential, which went public last year, but is a New York, Manhattan real estate owner, residential. And it's been a one-way trip south. It's trading at a record low. I own this one. And one of the real pain points of course, has been the election and the policies of Zoran Mamdani as mayor in New York, and what he wants to do with rent freezes, what he has done with rent freezes. Am I toast with this Go Residential?
Yeah, so I don't think you're toast. We just bought Go Residential this morning.
Oh, okay.
I mean, we've owned it for the last, call it 6 to 7 months, but we're still in the market buying. It's a broken stock in the near term. I mean, it IPO'd at 15. We're trading below 950, 930, around that range today. So, and we still think there are some funds that are looking to sell for whatever reason. I don't know what their rationale is, whether it's redemptions or that's their prerogative. We see a REIT that's trading a huge discount to its NAV. I mean, it's trading at like a 6.5 cap rate for prime Manhattan apartments. Manhattan vacancies are at a 24-month low. There's no new supply coming into Manhattan proper. Mamdani's scaring away anybody who wants to build a building in New York. Because
you won't get a return.
You won't get a return. They have modern buildings.
And not all of their exposure is to rent control.
Well, that's one of the best parts is like most of their units are free market, and that's their more expensive units. So it's something like, without having the numbers right at the top of my head, like 90% is not affected by these rent freezes in the next 2 or 3 years. They might hit a cap where then they will be, but that's still 2-3 years away. And I mean, I think when you look at Manhattan values over the long term, they tend to go whatever's going on politically with inside New York, outside New York, and Washington. They tend to go up and up and up. It's a city where people want to live. The office market's on fire. The job market's on fire. I mean, it's New York City.
Yeah.
Who wouldn't want to be in New York City? And so you get to buy premium assets. And let me just say, the guys running this,
You've met with them?
We've met with them. They're buying units. Like they're out there buying. They've vended these properties in. They're buying units. And the other interesting part is, so the NAV is $23 US.
It's trading at $9.
Trading at $9. Now companies will put out NAVs, and is it 23? Is it, maybe it's close to 16, 17, whatever. It's a lot higher, but they're actually buying properties using that $23 NAV valuation. So they're going to other New York City property owners and saying, look, our buildings are worth $23 a share. We're trading at $9. We don't know why, but they're worth $23. We'll give you units to buy your building, but we're going to give you the units at the implied $23 price. So if it's $100 million you want,
they're transacting at a higher level.
Yeah, you're transacting there. And that's what nobody believed them when they said we're going to transact at 23 and we're trading at 9 or 10. They went out and they did 2 deals like 2 weeks later. So yeah, I think this is it's like I said,
it's also it's a $500 million market cap, $600 million. Like, you got to be a certain kind of fund manager who looks at this. So maybe it's a little bit orphaned right now.
I definitely think it's orphaned. They're addressing that too. They're going to list on the New York's, or they'll list in the US. That's going to attract a US investor that I think wants to buy it, but they're like, I don't know how to buy stocks in the TSX. Like, I don't have Canadian dollars.
No, we got to do better though. We need those international investors.
Yeah, and I think they're going to get bigger. They're going to attract more. And like we're seeing REITs get taken out every week, it seems like. And I think, I give it maybe 18 months if this thing's not trading meaningfully higher. I think they'll say, you know what? Well, we bought a whole bunch at 9 and we'll take it out at 15 and take the other $8 upside for ourselves.
Okay.
We'll take it private again.
Okay, one to watch. Last in the mailbag, actually this one reported this week, UnitedHealth seems to be getting its rear in gear. It was a real embattled insurance stock. There was a lot going on. There was the assassination of the CEO that prompted a look at its billing practices. Medical costs were going up. Regulatory was moving against them. They were cutting their forecasts, which they hadn't done in a long time. And now they come out, they raised their forecast. It seems like the clouds are parting. Did you look at UnitedHealth when it was distressed? Do you own it now?
Yeah, we've owned UnitedHealth since 2019, I think, is when we first started a position in it. So we wrote it down. But again, we have conviction in our holdings. So we don't like to see our stocks go down, but when they do, it's an opportunity we think to buy in. And there was a quarter last Q2. They put out last year in July. They had gone through the tough times. There was the old CEO was back as the new CEO. They brought back their old CEO from 2015 timeframe. And they laid out a pretty credible path of like how we're going to get the margins up, because it was mostly a margin story. The revenue is there. Every year they increase prices. People get older. So the pool of revenue is there. It was the margins that were getting hit. They laid out a pretty credible plan how we're going to get margins higher, get our EPS from, it was trading around 14 EPS up to 20, 25 and beyond. And today they put out some results, and it seems like they're a year ahead of schedule on that. They raised guidance, margins are coming in way better. And so it was a very clean quarter. And I mean, the stock's done really well in the last 12 months, and we still think this is going higher. So this is a top 10 position for us.
Goes back to where it was before the crisis, like around 600. I mean, it touched 600 and then went down, but what are you thinking?
Yeah, I mean, I think 600 is a realistic in the next 12 months, and then beyond. There's no reason why this can't compound EPS at 12 to 15%.
It's 4:30 now. Okay, let's get into your top ideas, your pro picks.
All right.
Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, before we get into your new ideas that you brought to us, I want to review the ones that you brought to us February 19th, 2025. We'll start with the big winner, which was Broadcom. That one is up 70% since you chose it. Do you still like it?
Yeah, we still love Broadcom. So the CEO, Hock Tan.
And by the way, when you chose it, it wasn't like it was doing well, but it was actually, it pulled back in 2025, kind of going into Liberation Day. Then it shot up.
Yeah, it definitely had a bit of a pullback like the rest of the sector. But I think Broadcom, if you look at their revenue and earnings growth trajectory over the last 15 months, it should be up higher than 70%. Like it's had a lot of margin compression. Same with NVIDIA. The numbers keep going up and up and up and up. And the stock, particularly in the last 6-7 months, it just hasn't really followed. We think it's like a slingshot's primed for another big move higher. And like I was saying, the CEO, Hock Tan, legendary in terms of efficiency, ruthlessness. He's a guy you want to bet on. And he's a guy who's going to deliver. So when you hear these bear cases like, oh, MediaTek is going to eat their lunch, that's another company Google's working with on their chips, or NVIDIA is going to, just continue to outgrow them and push them out. It's like, I don't believe. I think Hock's like the guy to bet on.
Over Jensen Huang and NVIDIA, or it's different?
I mean, we own NVIDIA too. I like them both, but I mean, I think Hock's got more of that killer.
Oh, interesting.
Killer instinct, yeah.
Okay, well, Starbucks hoped that Brian Niccol had that. Of course, he was poached from Chipotle and he did wonders at Chipotle. And Starbucks, I mean, since you chose it, it's flat and it's been a real choppy stock and it really hasn't broken out. And I don't know, has the turnaround worked? Is this the best Brian can do?
Yeah, so I think the turnaround's working, but it hasn't been a straight line up like maybe we were hoping and some other investors were hoping. We've sold in the last couple of months around where it's trading today. So
just because you were fed up?
I think what happened with Starbucks is not long after the podcast, they did a big cut to their earnings. And it wasn't driven by performance. It was, we're going to invest in more people. We're going to put more people in the stores. That's going to allow us to have better service quality. So it was an investment in the long term, but that was a huge hit to the margin profile of the business. And so you just got a deep EPS downgrade right across the board for multiple years. And I think it is working. Like now they're seeing their same store sales improve. Brand loyalty seems to be trending better. They're getting new members to their Starbucks rewards program. So like the turnaround's happening. It's probably slower than we expected. And it came with this big investment in people, which really haircut the EPS growth. And so the stock's still pretty expensive. It's like a 30 times PE multiple. And so we decided to look for some other names.
Okay, let's talk about 3i Group, which trades in London, hasn't done well. It's down 33% since you chose it. And from what I remember, I know it's private equity, but it was really just a play on something else. They owned
Action,
which is a Dutch discount retailer. So did Action not do well? Like why has the stock struggled?
Yeah, so 3i is one that we still hold. We've been buying it up like crazy. I think it's insane where it's trading right now.
Why is it traded off? Do you know?
Why? Yeah, I can tell you why. So, I mean, it is action related. Pretty much anything that happens to the stock is action related. And Action, this is a company that's grown sales between new stores and same store sales growth 16% per year for like 16, 17 years. So it's been one of the great growth stories in retail ever. Like they have a chart where they're like, here's our sales, here's Walmart, here's Costco, and they're in that ballpark in terms of sales growth from $1 billion onwards. What's happened has really just been some slow comps. So they typically same store sales comps have been 6, 7, even 10%. They fell to 2%, 3%. Some of it was related to France. The French economy is really sluggish right now. Some's related to Germany. The war in Iran didn't help with just sort of Europe being, are we going to be able to drive our cars? Are we going to have gasoline tomorrow? So that's been the big hit. And the stock, it's all been, again, multiple compression. So you move down from, they put it on their books at an 18 times multiple. For a while, it was trading at a premium to that, call it 22, 23 times. And now we estimate it's probably trading at like a 10 times EV/EBITDA multiple.
So big discount.
Big discount. They're also, the other thing investors are looking at, they've announced an expansion into the United States. So that's really interesting to see them come all the way across the Atlantic into the US. But
discount, it's like Dollarama?
It's similar to Dollarama, Dollar Tree.
Yeah.
More discretionary. So it's not quite food related like Aldi and Lidl, which are some other discount grocers.
Yeah.
More discretionary, gardening supplies, sports supplies. But they do a market study. They looked at it for 3 years. They think their model is going to work. They're starting with a small bet in southern US, and they'll just kind of take it one state at a time. We just view it as a call option. If it doesn't work, they spend 500 million euros and then they go home empty-handed. It's a $40 billion euro company. And if it does work, then it's like, here's your growth for the next 25 years. And we've seen a lot of people say, oh, the US is the most competitive market in the world. How are you going to do it? We've seen so many companies from Canada, from Europe, come into the US and like kick butt.
Especially the dollar stores are a mess in the US.
They are. And that's
like, they're terrible.
When I was speaking to the CEO about that, I was like, what are you going to do about Dollar Tree and Dollar General? And he said, we're not worried about Dollar Tree. I think Walmart, and Walmart's the one that's kicking butt, and like Walmart's the worry. But they looked at going to the UK, which would be an easy expansion, just go across the English Channel and we're there. And they said, no, that market, we don't like it. It's not going to work for whatever reason. So they're not just making this bet because it's the US and like, oh, we'll just go try it out. They've done a lot of thinking. And actually their former chair, the guy named Adrian Bellamy, he used to be the chair of some big US companies in the retail space. And he's the one who's saying, I think you guys should go to the US. So he knows the US market well. So we'll have to see. It's going to be a couple of years so we know if it works. But if it does, I think it's just, here's your next 25 years of store growth.
Okay, so we're doubling down on 3i Group. You've brought a new group of stocks for us. And they're definitely not household names. They're not ones that I'm super familiar with. So I'm excited to learn more about them. The first one is New Holdings, kind of a Latin American digital bank.
Yeah. New Holdings started in Brazil. They really took like a Capital One kind of framework to growth, which is start with credit cards. So we're going to give credit cards to consumers who don't have credit cards, maybe can't get it from a traditional bank. Brazil's like similar to Canada. There's 5 or 6 big banks. They're sort of the gatekeeper to commerce. And so there was this huge underbanked market they started there, but now they've grown. The Brazilian business has been a phenomenal success story. I mean, I think over half of all Brazilian adults are now a new consumer in some way or another. They've expanded beyond credit cards into other forms of loans, other banking services. I mean, in Brazil, I think their revenue per user is around $15 US per month. And being a digital bank, not having any bank branches, it costs them $1 to service that customer. And and the mature consumers are at $30. So there's room for that 15 to go up higher.
Now, I wonder, the stock has been under a little bit of pressure, and I wonder how much of that has to do with new holdings, which you can buy in the US, it's ticker NU. How much of it has to do with new holdings and its performance versus just Brazil? Right now, Brazilian equities have been under pressure. There's political uncertainty going into the election.
I certainly think it's a little bit of the Brazil overhang. I mean, it is an emerging market stock. They also have operations in Colombia and Mexico, but that doesn't really lower your political risk. It just diversifies it.
Yeah.
But I mean, they do have ambitions to become more of a global player. So they're going to open up new markets, we think, over the next 5 years. But really, the big move down is they had some elevated costs from investments in their growth in the last quarter. And again, we talked earlier, sometimes investors just don't like it when you're spending money when the ROI is not certain. And that's what I think is at play here. But I mean, ultimately, this is a company that has had phenomenal growth over the last 10 years. Mm-hmm. It's trading now at the same PE ratio as Royal Bank in Canada. Like Royal's a 16 PE, New's a 16 PE. New's going to grow, if they hit their numbers, it's going to grow EPS 25-30% a year for the next 5 years.
And you can argue about whether Royal should have that PE right now.
Sure. No.
It's an expensive time to be buying those Canadian bank stocks.
Yeah, exactly.
OPRA is your second pick. Web browsers.
Tell
me what's so interesting about this. It's been very choppy.
Yeah, so it's been choppy, but we think they're on a pathway to success. They just put out a press release this month showing that in the US and the UK, where they're really trying to make inroads, so they have a lot of users in Africa, Middle East, Europe. They're trying to build up their Western user base for their OPRA browsers and products. And they're growing, at least on mobile, they're growing like 50, 60, 70% their user base. Their revenue per user, it's interesting. They make about $2 per user annually. So it's a very small revenue per user, but then they have 300 million users around the world. If you can get that $2 to $4, you can double your revenue. And there's almost no cost to serve a new customer.
Is there concerns that AI is a disruptor to this business?
I think so. I think that's been some of the choppiness.
Vibe code something?
That's been some of the choppiness is that what we saw, Perplexity has a browser and is a new income or new entry to the market. OpenAI wants to do a browser. And then you have Chrome, you have Safari, sort of the default incumbents. But Opera really plays that missing middle for the consumer who wants, it's a browser that's great for personalization, it's great for gaming. It comes with native like ad blockers, native VPN. So things that Google Chrome's not going to put an ad blocker in Chrome natively. You can install one, but that's not going to come with that. Safari, it's to control the Apple ecosystem. So this is really the independent browser. They've been gaining users. And the financial model is growing EBITDA 20%. They have no debt on the balance sheet. They're buying back stock. They actually have two very interesting hidden assets in Africa. They have a company called OPay, which is a Nigerian digital bank.
Okay.
It's actually worth about $4 billion. It's probably going to IPO. They own 10% of that.
Interesting.
And then they have another asset inside Opera called MiniPay, which is a stablecoin wallet. And it's small. It's doing about $15 to $20 million of revenue, but again, growing 100% year over year. So some upside there if that can continue growing.
Okay. And the last one, Vital Infrastructure Property Trust. It's a healthcare REIT. Nice dividend, 6.5% dividend yield, a bit of a yo-yo as a stock. What do we like here?
So you're going to be hard pressed to find too many 6.5% dividend yields out there right now. Vital
that are sustainable.
Exactly.
Yeah.
And 4 years ago, this company did cut its dividend. So they went through a very tough period where the debt was too high, payout ratio was too high.
Because of COVID? That forced it? Or
it was when interest rates went up and
spike,
property values came down. They got caught with too much short-term debt. That was 2 management teams ago. So that's in the past now. And like forward looking, they've sold off a lot of properties. The balance sheet's in great shape. They just hired a new CEO from Brookfield, formerly from Brookfield, who's got some really great ideas how to run the business. The chair of the board, Bobby Julian, has bought 10% of the company just out on the open market, said, I like this company. I like what they're doing. I'm just going to put, a whack of my own money into it. So you have a really aligned new management team, and they own hospital-like infrastructure assets. So they are global. They're trying to consolidate into North America. So they're selling off some of their global operations, but mostly hospitals, surgical outpatient facilities. In a lot of cases, they're leases with the government or government adjacent healthcare body, and long-term leases. They have 10, 15-year leases on some of these properties. They have rent escalators. So it's not a huge inflection in terms of the growth, but it's just for an infrastructure, almost bond-like cash flow. You're getting 6.5% dividend yield. The NAV value on this is, I think, around $7.50 to $8. They're selling properties at NAV, so that NAV, I think, is validated. And now, again, we're seeing REITs getting taken out left and right. I don't think this is a takeout candidate in the next 12 months, but if we're still trading below 6 in 2028 when they're on full in growth mode, I think you're going to see the new CEO and that chair who I've talked about say, why don't we just take this private, and if we're not getting the
have it for
exposure
ourselves.
In the public market.
Stock's trading around $5.53, and you said the NAV is around 8?
Yeah, it's around 8. And
okay.
Like I said, there's no reason why we've seen other REITs close that discount. And I think VITL, as it's now called, will do the same thing.
Okay. What was it called?
It used to be Northwest Health.
That's what I was like. There's another one of these out there. Because I was thinking it's Northwest.
Yeah. So
they did change the name. Yeah. All right. That makes a ton of sense. Yes.
Right,
we have seen this before. Thank you so much. I love these outside the box ideas. Thanks so much for joining us and sharing your time in the past hour.
Thanks for having me on, Amber.
That's Jamie Murray joining us. Don't miss our next episode. We've got Scott Morrison of Wheelhouse. He actually got seated by Jim Balsley. He talks North American stocks. If you've got questions, you can email us questions@inthemoneypod.com. Find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.